the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian. I will take you through how the Singapore stock market fared for today, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares dipped today as investors mull a mixed day in Asia. So if you look at the Straits Times Index, it was down 0.04% at 2:17 p.m. Singapore time at 4,244 points. And that is with a value turnover of some 584 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI managed to inch up at the end of the trading day, up 0.19% at 4,253 points. Now in terms of value turnover, that's 1.17 billion Sing dollars. Gainers trailed losers though, 232 versus 281. Top advances for today we've got for you XMH, UOB and DBS, and top decliners we have here GMH USD, Jardine Cycle and Carriage, and Shangri-La Hong Kong dollars. Well, in terms of companies to watch, we do have CapitaLand Investment because its subsidiary, CapitaLand Commercial C-Reit, received approval from the China Securities Regulatory Commission yesterday to register for its listing on the Shanghai Stock Exchange. Now, elsewhere from investors' reactions to a better-than-expected set of earnings out of chip titan Nvidia, to South Korea's central bank holding rates steady for a second straight review, we've got more corporate and international headlines in focus. And joining me on a Thursday is David Chow, Director at Azure Capital. David, welcome back to the show.
Hi, Nitin. Thank you for having me. Hi, everyone.
Great to have you. And David, all about Nvidia today. I mean, its quarterly earnings beat expectations, but shares were down over worries about its stock business in China. Now, if we look at some numbers, Nvidia posted a profit of $26.4 billion USD on a record revenue of $46.7 billion USD in the recently ended quarter. How would you read into Nvidia's latest results as well as investors' reactions?
I think Nvidia, at this current juncture has become one of the stocks whereby you either love it or you don't. So which camp do you belong to, Tian Tian? But before you answer that, let me just modify the question for you slightly, just in case you are going to say you belong to the latter, camp, and you have to interview some executive from Nvidia in the near future. So here goes. Do you like the stock now on the valuation perspective, given its current forward PE of about 40 times, with a consensus earnings growth of 52%, for FY26?
You know what? I will take on the journalist view and have you tell us the answers, or help you tell us your thoughts instead.
Okay. Moving back to your question. So, let's talk about this set of results. Vis-a-vis consensus, revenue was a slight beat, and the EPS of 1.05 was also a beat against estimate of 1.01. So, against my expectation, both top and bottom line, certainly beat mine. And I think the real issue was its guidance. Nvidia said its upcoming 3Q sales will be about 54 billion, in line with, I think, from what I could see, the average Wall Street estimate, but less than what some analysts had actually projected. And you have mentioned, China as a stalling factor. So yes, revenue in China, which includes Hong Kong, actually declined 24% to 2.8p. But for that, we must remember that the company did not sell any HDD chips designed specifically for the Chinese market in order to comply with the US export controls during the quarter. And in comparison, these sales, HDD sales, actually generated about 4.6b in the previous quarter. So this is a significant amount. And what's more, Nvidia is also, of course, facing regulatory pressure from both sides, US and China, and it has not really resumed shipments of H20, even though certain China-based customers, have been granted a license. So for that, it's interesting to see, how this will pan out in the coming quarters. And looking at share price performance, I think share price has perhaps more room to go sideways in the absence of positive news flow in the short term. Since the share price has pretty much ramped up with anticipation of these results for the past week. So let's just wait for more news flow in the meantime.
And, talk about Nvidia's results. Yes, affected the movements relating to AMD, TSMC, Broadcom. If we look at Europe, ASML as well. But where Asia is concerned, how far have Nvidia's results filtered through or influenced the movements of Asian equities in general?
Right. I would say perhaps the Nvidia's result, the effect will be more pronounced in the earlier trading hours. But, throughout the days, basically what we have seen is that Asian equities have displayed, resilience today against these mega earnings, with the likes of, Chinese and Korean tech stocks, actually recover from early losses, after Nvidia's guidance miss. With it, we've been seen as, creating possible breathing room for, domestic champions in the respective countries. I guess if both Europe and Asia can weather the sell-off, Nvidia's jitters will start to look, less like a global story and more like a U.S. policy one, with Washington's export curbs and political risk amplifying volatility around a single stock, that U.S. equities have previously relied on for gains. So I guess the effect will be kind of short-term. And of course, if we get more and more names, missing related, semicon names, missing earnings, this could be adverse. But let's see how that pans out.
Okay. And if we go back to the Singapore stock market today, David, how did the STI fare? And any surprises if we look at the biggest movers and the sectors that they lie in?
Well, with a 0.3% gain, I would say STI is still pretty much flattish today. And at current levels, I think it's still undergoing the consolidation within the range of about 4,188 and 4,284. And it remains so. So for the sectors, I don't see any noteworthy movement today.
Okay. And let's zoom in on some of the counters to watch, in particular CapitaLand Investment in focus, because its subsidiary, CapitaLand Commercial C-Reit, received approval from the China Securities Regulatory Commission, the CSRC, yesterday to register for its listing on the Shanghai Stock Exchange. How significant is this piece of news for CapitaLand Investment, and accordingly, how have investors responded?
I think this listing will still very much have, in my opinion, a minor impact to the company's second half of this year in terms of additional fees coming from this C-Reit listing in the second half. And in the grand scheme of things, the upcoming second half results will be mainly boosted by event-driven fees owing to various REIT transactions. And in addition, I think we all have come to know that the company is aiming to dispose about 500 million worth of Chinese assets in addition to other asset sales in India. The company is also expected to book some disposal gains, post these sales. So one key thing to look for will probably be the borrowing cost, which could drop below 4%, and this could be a tailwind for earnings. And investors should also be mindful that the company sees itself pursuing growth opportunities at the moment. So for those hoping for corporate actions like maybe your share buyback, they could be disappointed. And management has actually guided that it does not intend to pursue a share buyback at this moment, but rather focus on its growth plans. So I guess what our company intends to maintain, I think it's 12 cents final cash dividends with no plans for interim dividend. It may still consider paying an interim dividend when its operations are slightly more mature. So investors should be tracking whether value could really be unlocked as the company progressively disposal is about 4 to 5 billion investment property portfolio and subsequently recycling the proceeds back into its operations. So for this company, we actually have a June 26 target price of about 320.
Okay. Now, we do have another counter to watch. We don't talk about this counter usually. In fact, we have not talked about this counter. It is called Singapore Pain Care, which is a Catalyst-listed medical services company. Now, Singapore Pain Care requested its trading halt to be lifted after it called for an upcoming scheme meeting to be postponed. So a lot of things happening. Basically, what happened was that initially shareholders, they were set to vote on a privatization offer via a scheme of arrangement. But the company sent 2 WhatsApp messages to shareholders ahead of the meeting, which the Securities Investors Association Singapore, or SIAS, said was a breach of Rule 8.6 of the Code on Takeovers and Mergers. So what are your thoughts?
I think a breach of this Rule 8.6 is definitely significant. I think because if I look at it, I think the rule essentially requires all communications relating to an ongoing offer to be seen as fair, transparent, and equally accessible to all shareholders. So by using WhatsApp, which is could be a selective informal channel, I think the company sort of created the impression of selective disclosure and possibly influencing shareholder voting. So this kind of undermines confidence in the fairness of the whole scheme process. And the decision, I think, to postpone the scheme meeting so actually indicates the company and possibly his advisors, they want to avoid any risk of the vote or the entire scheme being challenged on procedural grounds, and the scheme or arrangement already requires court censures. So if there's evidence of a breach of the Labour Code rules, the court could refuse to approve the deal even if shareholders vote in favour. So the delay is possibly a defensive move which ensures some procedural integrity before moving forward. So for investors, the key takeaway is this: the privatization offer, I think, is still very much alive, but the spotlight is now firmly on governance and process. And as we know, regulators in Singapore take these rules very seriously. So even small lapses like this could cause delays. So while this looks more like a temporary hiccup than a collapse of the entire deal, I think it does mean the timeline is stretched here, and scrutiny around the offer will be much more higher going forward.
And across the region, David, South Korea's central bank held interest rates steady for a second straight review today, and that's amid concerns about financial imbalance risks caused by a rapid build-up of mortgage debt. So the BOK's 7-member Monetary Policy Board voted to keep interest rate unchanged at 2.5%, which was expected by most economists polled by Reuters. How far is this within your expectations, though, and how have the South Korean won and South Korean equities reacted in response?
Right. For this, I didn't expect the central bank to cut this time, certainly not before the U.S. So I guess with this, this is quite, within my expectations. However, this decision by the central bank to retain is really not a sign of dovish slackening, or rather it reflects a balancing act. The BOK, I think they actually cited the growing mortgage debts and risk to financial stability, especially from Seoul's tightening housing market, as key constraints on further easing. So at the same time, there are also external pressure building up, such as U.S. tariff continue to weigh on the country's growth. So in short, I think your market very much expected a pause, and that's exactly what they got. So with this, I think the won actually edged higher after the decision. And for the South Korean equities, I think it gained about 0.3% today. I think as investors in that market actually welcome the calm expected tone, but without aggressive easing that might fuel speculation in the debt-laden housing market.
Okay. Before we let you go, David, we must talk about coffee, much needed at this time of the day. Consumers who are already shelling up more for their morning cups of coffee, they cannot catch a break because tariffs, fuel price hikes, and put future markets on track for the biggest monthly gain in over a decade. Any quick thoughts before we let you go?
I guess what we're seeing is in the morning coffee, it kind of becomes a kind of symbol of the broader inflation story, whereby you see global trade policies, shipping costs, and weather shocks all collide in the price of something as ordinary as a cup of cappuccino. So for households, I guess it means your daily cup is steadily more expensive, and for businesses, especially for cafes and food services, it could perhaps squeeze margins even further. And from an investor's point of view, I think it's a reminder that commodities are being driven by both fundamentals and geopolitics. Coffee is just the latest example, but the same themes are actually playing out across grains and other soft commodities. So consumers feel it at the counter, and traders are watching for volatility on their screens.
Okay, lots to watch indeed. Thanks so much. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.